take my office, please. Someone pay me some money.
The valuation of these properties is based on its ability to generate the rental income, right?
The problem's getting bigger and bigger and bigger and bigger. Now with the AI wave, it just gets boom, another huge, all the solutions that they had hoped for are gone. There is no solution.
Yeah. If this is actually a problem and the government rezones the top 10 levels of each of these to like resi penthouses and you sell them off, like happy days.
So the big uncertainty here is there's a giant lie happening at the moment. I think that's well and truly clear.
I don't see a huge case for there being massive like contagion into other sectors, other parts of housing, other parts of the economy.
Like, how big is this sector? That's going to be a big question. Who holds the debt? How does it flow through to the world? This is the biggest risk to Australian property right now. In this podcast, we're going to go through the 4 lease signs that are absolutely everywhere in the Sydney CBD and in every CBD across Australian capital cities. I'm going to go one step further. It is everywhere, globally, all at the same time. That is, there are trillions of dollars of debt out there at the moment that is not currently getting serviced, not currently getting paid because there are offices absolutely everywhere that are not rented out. You can put this 2 and 2 together in your own mind and be like, what on earth is going on? No one is talking about the reality of what this could potentially cause. In this episode, we're going to go through the biggest danger to Australian property that exists right now, the commercial sector, and more importantly, the office sector. Curtis, how are you going?
Yeah, good. Although that was a very ominous intro, so maybe less good for this one than our normal upbeat residential property analysis.
That's great because I was going for the ominous.
You're going for ominous?
I'm glad you
scared me.
I'm glad you had that. I can smile now. Yay. Okay. But this is not something to really smile about because, Kurt, we are looking for an office right now and my God, it's so annoying. Like I put in one inquiry and my phone just goes off a gazillion times.
Yeah.
And then I get shown every single building. Like literally, I walked a street in the city, like Castlereagh Street or something like that. Every single building, every single one of them. I couldn't count one that wasn't for lease, that didn't have a for lease sign. And the one that didn't have a for lease sign, I had seen from it with like a sublet opportunity being like, please take my office, please, someone pay me some money. Please rent my little office building out.
Yeah. And this is like we've seen.
It's the best.
Yeah.
Did you know that?
Exactly. Yeah.
It's worse everywhere else.
Yeah. And not just like if you take a broader perspective, it's not just an Australia phenomenon either. Like post-COVID, when, you know, people have worked from home and there's been a fundamental shift in the way that businesses and people work and how much floor space really businesses require to operate effectively now has shrunk. And that's just created in all the big CBDs around the world, massive vacancy rates.
Yes. Big problem. Reason why it's a big problem is because these towers that you see, they're large, they're big, they're everywhere in the Sydney CBD and across the Sydney capital and everywhere in the world in their major capitals and every single city in Australia right now. Now, if no one is renting them, they are backed by debt. These towers didn't rock up because someone had cash there.
Yeah.
There's just mortgage debt, commercial bonds and commercial debt behind the scenes everywhere against these towers. Now, those debts, they have interest payments. They have large interest payments. Interest rates have risen materially from when those points of construction were happening.
Yep.
It's not 1% or 2%. It's 6, 7, 8% on these debts. And that's assuming, you know, they're backed by a solid creditor there as well. It could be more than that for these offices. They're not getting paid. No one's getting any money here, but they're making those debt repayments. And it's been years. And it's going to get worse. Like, let's not be real. Like, AI is taking over. People are cutting jobs. CBA is like going to cut like a bunch of people all the time. All the banks are cutting people. Every conversation that I have, I'm running a business and I'm thinking about how I can, you know, ensure that the business is sustainable going forward, do things faster, quicker. It's going to get worse. This is a debt problem worldwide. Like, it's too big.
Yeah.
What do you think?
And I think the point that you made that is really crucial here is we're not talking about, yields softening because there's less demand and, interest rates have gone up. So your net yield number is changing. It's zero yield, as in
Zero.
vacant,
Zero.
and
Yeah.
vacant for an extended period of time.
Yeah. Freaking the strata costs on these buildings alone. is
Exactly, yeah.
enormous.
And getting someone to sign on for a 3, 4, 5 year lease, you're getting what do they call them? Those headline tenants, basically. Like, that's very, very tricky at the moment. And a lot of businesses, particularly smaller businesses, either they in need of something a bit more flexible, not willing to sign up to massive long leases because their staffing requirements and office space requirements, they know that they're moving.
Exactly. You know why this is a bigger issue? Is like, I feel like we might be talking about this in a few years. Like, I've done so many, I was at uni during the GFC or right afterwards, and we had to do all this analysis as to what happened, right? There's just so much crap happening. It's a giant lie. That's the best way to describe it. What's happening right now with this sector is it is a giant, big Ponzi, complete lie from every big player involved. Whoever's talking about this is just pretending. And that's exactly what's happening right now. Like, there's literally a term for this where it's extend and pretend tactics.
Yes.
They're just pretending. Like, and I know they're pretending because I was there being like, what? My phone's going off. I'm getting offered 50% discounts. I'm like, maybe I should ask for 80. Like, just ask for it. Be like, they'll probably just find a way to be like, please, someone take my property. That's exactly what's happening at the moment, where it's just like desperate. That sounds like horse territory, right?
Yes.
That's nonsense. And it's backed by debt, like a lot of debt, right? Like, how big is this sector? That's going to be a big question. Who holds the debt? How does it flow through to the world? But we've been through this once before. That's exactly on the underlying faction of the GFC, where it's like all these people had debt, but it was all freaking pretend debt. Like, people had pretend incomes and it was all fake.
And particularly when, even if it's financed at 65, 70% LVRs, like the valuation of these properties is based on its ability to generate the rental income, right? Yep. Like, these are office towers. They're not necessarily valued on their land component so much. It's like, what is the yield that they're generating? And if the answer is that falls by half, then that is, your valuation crashes.
Yeah, exactly. Yeah. 65, 70% LTVs. Yeah, they're in negative equity.
Yeah.
They give the keys back. Take it. I don't want it. Like, I don't know how this plays out. Like, the transpiring of the dominoes, who holds this debt, the composition of the risk of where this debt lies. I don't think it's an Australia risk. I think it's a global risk more so than Australia. Australia is just going to be dominant that feels this.
Yeah.
Credit markets will then flow through. And this extend and pretend tactic, I actually think it's not only in the leases itself. I actually think this extend and pretend tactic is now flowing through into the debt markets behind it. So you start with this problem up here. The problem here is offices everywhere not generating income. They're generating less than half of the income that they typically generate over time, and they're everywhere. That's the problem.
Yeah.
Right? Then the problem dominoes through to the holders of the debt because they're not getting paid. Right?
Yeah.
And like all these people are being like, hey, can you just, cap my interest on top, and be like, we need to pretend this out longer and longer and longer and longer. But now it's 2025. This problem began in 2020. We're 5 years in. The problem's getting bigger and bigger and bigger and bigger. And now with the AI wave, it just gets boom, another huge, all the solutions that they had hoped for are gone. There is no solution.
Yeah.
There's no rainy day. There's no rainbow at the end of it. It's gone. There is no rainbow. That's finished. Then you look into the debt markets and it's just like, okay, so who's holding all of this debt? And how is this debt transpiring? And then you look at what you would expect to see, being like, this extend and pretend, let's just extend it and pretend it's all okay. You start seeing the composition of debt shift. And if you look at private credit growth, you just see enormous private credit growth happening through the roof across the world. Like, it's just a huge, huge sector that's just shot up. Imagine some of the underlying assets backed against this. It might be MBS type securities and stuff like that, just jumbled in. Be like, let's throw an office in here, let's throw an office in there, let's throw an office in here. Be like the private creditors seeing 15% yields. You can get 15% yield on your investment if you go buy one of these credit bonds out there. I think some of that is that office territory. It's probably mashed up like a sausage.
Yep.
And
That is
people are
how to
buying-
do it. Yep.
People are buying these products.
Yeah. So maybe it's useful to give some numbers behind what we're
do it.
seeing to just unpack it a little bit.
Yeah.
So just to give a bit of an idea on what vacancies look like. So Sydney CBD currently about maybe 12% vacant. I reckon that's
It's double that.
quite undercooked. Just going through some office buildings and seeing how occupied they are. But like historically, 4.1% is the number from 2018 pre-COVID, maybe even just call it 5. But I reckon we're looking at like minimum triple vacancy rate from where we were pre-COVID.
Yep.
Similar in Melbourne. Melbourne's even slightly worse, 15% vacancy rate, was running just under 4. Brisbane a little over 10% as well vacancy. Perth and Adelaide 17, 18% vacancies. Like national average, we're talking like 13% vacancies compared to 8 pre-COVID. So there's been a big rise in vacancies, and like you say, I feel like those, particularly in Sydney, because we've got a little bit more on the ground exposure there, those vacancy numbers are only likely to rise as more accurate data and more current data reporting flows through.
I'm not so sure they'll rise. You know why?
You don't think the more accurate,
We're playing pretend. All
that
of
more
this is-
accurate and recent data reporting won't happen?
Yeah, no, all of this is a giant makeup exercise. Like, they're not going to change these stats. The whole commercial sector, the whole commercial office sector is the giant. It's the most big lie I've seen in asset valuation. It's all fake. They say I rent for this, then you actually rent for this tiny amount. But when you look at the underlying lease, you look at the documents, it says this number, and then there's a separate document that says, hey, you don't have to pay any of that. Like, let's just give you a whole range of discounts. Can you please sign this? What the hell? That's like, it's unregulated horse sense. It's nonsense. And it's horrible that this is being allowed to be done. And in time, someone's going to look at this being like, who the hell allowed that? That's crap. Like, these vacancy rates are nonsense. Like, they're just made up numbers. Yeah, it's up three times that level. But inside all of these buildings, there's sublease opportunities for pretty much everyone.
Yeah.
And you just go in there, they're empty, they're backed by people where it's just like, you can sublease my office if you want to.
Yeah.
There's space everywhere available at the moment. So I don't believe this, and I suspect that it's worse and worse in other cities that might show it a bit differently.
I know we're getting very speculative here, but I do think the upside of this, the only way I'm thinking that this is less susceptible to a global like financing issue is that there's more ways out of this, which is like,
Ooh, how do we get out of it?
like if this is actually a problem and the government rezones the top 10 levels of each of these to like resi penthouses and you sell them off, like happy days.
100%. They'll allow
Like
that.
there's the floor space is there. The floor space is needed by the population. It's just not zoned and purposed for people that actually want it. So unfortunately, if that's the way it's zoned and you're running the asset valuation on what it is now, then it is what it is. But to me, it seems like there's some fairly logical ways to adjust things to get out of a problem if one were to eventuate. That, if you're talking like the GFC, like not those options weren't there.
Yes, that's true. So you have to spend more money to, after a 5-year time period. So they need to, debt levels have crept up and up and up on these or they may have been reshifted into other areas of debt, but they would have kept increasing because no one's making these interest payments. And then on top of that, you need to have a new repurposing of all of these buildings into residential. So a huge change cost from one type of dwelling to another. God knows how expensive that is. Hopefully that's commercial. It should be because they rent for significantly high amounts.
Yeah, or you sell them. Yeah.
They sell them. And then there's potentially a spread difference in the price. I don't know if an office costs more than a residential home. I'm not too sure the difference.
But that's the issue, right? Like the demand for offices is tanking, but the demand for like housing, the demand for residential dwellings is unlikely to tank.
Some of the debt can close off. So that's true. Can you give me the sense of the global problem? How big is this globally?
Yeah, so we've got some other like big cities or CBD areas as well that we've looked at. So like Manhattan, New York, like 23% vacancies, which is basically like call it a quarter. And it
That sounds more real.
Yeah, that
San
sounds
Fran
more.
at 13. Holy moly. San
Yeah.
Fran. What's going on there?
I mean, they're like more tech because that's like Silicon Valley, right? I mean, San Jose, I guess, but like
What are they doing? They're working from home, are they?
Yeah. Or I assume AI agents are working for them. I don't know. I would imagine San Fran being one of the tech kind of capitals of the world would probably be one of the fastest to react to changes to like work from home, AI, those kind of things. London, 16%, which again has doubled. The average of Europe's capitals is at an 8% vacancy. I haven't really broken them down here. So that also seems potentially a little bit undercooked, but also double what it was pre-COVID. So yeah, you're seeing it's not just a Sydney or a Melbourne thing. It's all the big CBDs that are office space reliant have huge vacancies compared to what they were pre-COVID and don't really have any prospects of that changing quickly. The only thing that we have kind of seen doing this little deep dive is there does seem to be a slight difference between premium offices, like A-grade offices and B-grade offices. A-grade offices are still in demand. There's kind of like a flight to, it's like, well, if I'm going to have an office, like, let's at least go get a nice one.
Yep.
It's really like that middle of the market stock that is getting smashed.
We've noticed that, right? Like we keep getting shown all these beautiful internals. Be like, wow, this is nice.
Yeah.
Right? So that needs to happen now because people aren't going to come into work unless you have a beautiful office. So you can see the conversion into nicer offices happening there.
Yeah. And with less demand, people that need offices are effectively pseudo upgrading for, the same cost. Yeah. But it's that middle of the market, what they kind of call the B grade, C grade office space that's getting absolutely smashed.
Yeah. Okay, so can you think about the impact on the debt market? That we've touched on this a little bit, but I think this is a banking sector risk. I think we've got some words from the RBA here as well and how they viewed this. Do you mind unpacking this a little bit for us as to like the domino impact through to the debt market and how much of a risk it is to Australian banks? Yeah,
so the RBA have kind of noted that they've got Australian banks have less exposure than they did in 2008. So if you're just looking at a total exposure to commercial real estate, in debt terms from the Australian banks, they're not too overly exposed. The RBA's concerned, but I don't really have the breakdown, and it's probably commercial in confidence anyway. I don't know how to ever get it. But it seems like the larger institutions are a little bit more diversified, and the RBA doesn't have very many concerns about their ability to deal with significantly falling commercial real estate valuations, defaults, things like that.
Told you, it's all been refinanced to the private credit
Yes,
sector.
it's your small guys. Their size means they're naturally less diversified. They're at way more risk of having effectively defaults, bankruptcies as a result of the assets that they're securing being worth 50% of what they signed up for, and the debtors just not making the payments and walking away.
That's my summary of this. The big uncertainty here is there's a giant lie happening at the moment. I think that's well and truly clear. There's a big problem there that's very, very real. That's not a lie. You could just go around, take a look. Anyone could go and do that. You can do that little, what's that movie called? The Big Short? Is that what it is? You can do that around you. You could just go to every capital and be like, what? Everything's for lease. Just anyone watching this, if you're in Sydney CBD, go for a walk and count. Go on your lunchtime walk and count. Be like, how many did you see? And be like, isn't that a bit odd? Does that seem a bit strange? So they can't lie about that part because they can, but they put the for lease signs up.
Yeah.
So the real estate agents are doing their job. I don't think they're the ones driving this. They're just trying to solve it, being like, can I please get my commission check for getting this done? And they're struggling there. So they're doing their job, but the for lease signs are everywhere. The lie is here. It's just how big of a problem is this? How big is one sector of the total housing stock? Is housing the right word?
Yeah, real estate.
Real estate stock. One form of real estate stock being in the doldrums. How much of a problem is that? How big is the debt problem? And how does that domino across? Unlike 2008, the problem sector was the residential housing market, which makes up 70% of it, right? So it'd be like, if that's the problem, then it's game over, right? So that's what caused that situation then. This time around, it isn't the size of that. It's more isolated. It's a smaller sector. Its debt is being shifted across to private credit people who, you invest your money with your own risk frameworks there. Yes, it can create chaos, and this extend and pretend tactic is probably going to mean that the size of the pain is larger when it does hit. And soon enough, I think I'm going to start seeing default in these sort of sectors. And then there's the government who might just be able to be like, here's some checks. Let's write this off.
Yeah, or let's rezone it as like residential.
So there's solutions.
Yeah, I think there's some more solutions in this space. Yeah. Admittedly, you probably don't go for any of those solutions until things get quite bad. But there's some more obvious solutions here about things that governments can do to step in without needing to necessarily bail any banks out, but just allow for some repurposing of assets to effectively what's become a higher value use to the community.
Agree. So my actual takeout here is there's a lie happening. It's wrong. There needs to be some level of regulation to all of the fakeness that's happening here. It's really, really surprising. Every time I converse in this space, I'm like, it's wrong. That's how I feel about it. It doesn't seem straight. And even real estate agents, they kind of say, it's like, yeah, there's all these weird stuff here. We just play around with the numbers to make it look good. The reason why they need to do that is for debtors and for asset holders and to sell the story a little bit. So they're all selling a giant lie. But the flip side is, I don't think the size of this and the solutions to this may mean that it's insulated a little bit, and the Australian property sector may it's just one of the worldwide events. It's one of the many things that are happening. There's war out there. There's oil price changes. There's trade wars. There's all these stuff. It could just be one of those external sectors that don't
I don't see a huge case for there being massive like contagion into other sectors, other parts of housing, other parts of the economy. Like, it's not good, but like you say, the size of it, where the debt's held, the kind of all those factors matter. What your options are to get out of it all count.
Yeah, that's the takeout. Big risk to certain markets. Big risk if you own one of these offices. Big risk in general, but nonetheless unlikely to really create that much of a dent to the housing market itself. The nature of who holds the debts, the size of the debts, etc., is unlikely to cause contagion in financial markets as well. And there's so many policy solutions that Curtis has, his policy brain has come up with solutions very, very quickly there that kind of insulate us from this. And then there's just the general sort of bailouts that are possible to some of the debt holders if it does cause any form of risks here. We've got really sharp solutions, very fast solutions to ensure the flow of credit continues. So if I'm a property investor, this is something to just be mindful of and be careful of in terms of asset selection. I'd be mindful of buying any debt type assets that are tied to this. But really, if I'm buying residential property, I don't think this is much of a risk at all.